Hello everyone, this is Bhavik Chokshi here and I hope you guys are doing great. Today we would be doing a quick overview of the mutual fund chapter in your CA final SFM. It is an important chapter and a scoring chapter as well. So let us get started with the concepts of mutual fund. So to start with, what is a mutual fund? A mutual fund is a collective investment scheme where the fund gathers small investments from a large pool of investors, get experts to manage the fund and generate return for the investor. So this is very helpful for people who do not have really good investment expertise and do not have as much money to diversify fully, so they can invest in the mutual fund, and that mutual fund will invest the entire pool of money in a diversified group of assets. So this is just a general theory for the mutual funds, very popular instrument in India and across the world as well. Now, there are two main types of mutual funds. There is the open-ended fund, whereby the investor can enter the mutual fund whenever he wants and exit the mutual fund, that is claim redemption, also whenever the investor wants. So these open-ended funds are open for entry and exit whenever the investor desires. However, there are certain close-ended funds whereby the investor can enter at a particular date by subscribing to units directly, and then there is a fixed redemption date where the money can come back. Now, these close-ended units, if I want to transfer, am I stuck? Well, usually yes. However, these units are traded on the stock exchange, and hence even the close-ended units, you may not go to the company, the fund, and claim redemption, but you can sell it to someone else as well. Now, for open-ended units, we are saying that we can enter the fund whenever we want and exit from the fund whenever we want. So that is an excellent flexibility available. We don't have to go in search of buyers. However, at what price will this entry and exit happen? This is happening at something called as net asset value, or called as NAV. Now, the performance of a mutual fund is assessed considering the NAV of the fund. Like in mutual fund, there are units. For company, you have shares. In mutual fund, there are units. Shares cannot be in decimals, but units can very well be in decimals. So how will you find the value of these units? One of the best methods to consider the value of these units is considered to be the NAV. How do you calculate the NAV? Well, we will take the market value of the investment portfolio. What is there in the investment portfolio? Well, you can have shares, you can have bonds, you can have commodities. You will take the market value of these investments. Typically, you will be given in exam questions, you will be given the cost of these investments. Let's say you have invested 2000 rupees in listed shares when the Sensex, let us say, was 10,000. Let's say after a year, Sensex becomes 12,000, that's at the return of 20%. Then how much will your investment be? We will say, will it be stuck at 20,000? No, it will also increase. So if the beta is 1, for example, if the Sensex goes up by 20%, you will also go up by 20%. So that is whatever was your investment, 2,000 plus 20%, that is equal to 2,400. Alternatively, you might carry a different beta, in which case you will have to find the value of your investments accordingly. Secondly, you might also have some other assets apart from investments, like cash. The complexity in cash may be you might have to calculate cash balance by considering the issue proceeds you have received, the issue expenses that you will have to pay, the investments that you make, the sale proceeds that you generate, the money that you pay to the fund manager, the distribution that you give to your unit holders. After considering all of these adjustments, you will get a closing cash balance, which is also an asset for the fund, and hence it should be a part of net assets value. Apart from this, there can be other assets as well, like you might have invested in companies or bonds, and these companies have announced dividends or announced time has passed and interest is accrued. However, you have not yet received them. And as a result, this is a receivable that can also be a part of the net assets. So we are just talking about assets. Are there also liabilities? Well, usually relatively less, but there can also be liabilities in the form of, let's say, fund managers' charges which are yet payable. Or let us say there are certain partly paid shares where calls have been made and you have to make a payment on the calls. So these are all liabilities, and after that, whatever value you get is the net assets value. This is for all the units in the fund. You divide it by the number of units on a particular date, and that will give you the NAV. And this is the NAV through which you track mutual fund performance. If I want to enter into the fund, I will buy at the NAV. prevailing on a particular date. If I want to exit the mutual fund, then I will exit at the NAV prevailing at a particular date, and hence NAV is very important. A lot of students who do their industrial trainings also calculate NAV on a daily basis. I hope you understand that since the mutual fund portfolio is in listed shares, bonds, etc., the value of these instruments can regularly change, and hence the NAV can regularly change. So this is about net assets value. You do get sums on NAV calculation. Then you have the questions which are on calculation of return and the types of funds. So first of all, in case of a regular income scheme, so if I look at a regular income scheme, I invest in the mutual fund unit. After a specified period of time, the NAV might appreciate. Apart from that, the mutual fund might give distributions. These distributions can take various names and various forms, like dividend distribution or capital gains distribution or any other form of distribution. So how will I calculate the return? Well, in a manner which is very similar to that which what I do in portfolio. Like in portfolio, we take P1 minus P0, that is price at the end of the first year, minus price today, plus distributions or dividend upon P0 into 100. In a similar way, instead of P, we take NAV. So NAV at point N, let's say after 1 year, minus NAV that I started with today, that is NAV 0, plus the distributions during the period. So that will give me the total return. So let us say I start when the NAV was 10, at the end of the year NAV becomes 11, and during the year there's a 0.5 distribution, in which case 11 minus 10 plus 0.5, that is 1.5 is my return on an investment of 10 rupees, and hence 15% probably is my return, 1.5 upon 10 into 100, that I've done on a per unit basis like I do in portfolio as well. However, there are certain special schemes, and before we go to those special schemes, we also need to understand the concept of annualization. What do you mean by annualization over here? This is a return that you have calculated for a holding period. Let us assume the holding period was 1 year, and hence 15% is the return per annum. However, what if this holding period was 2 years, in which case the NAV becomes 11.5 after 2 years? You invested 10 rupees today, and over the 2 years you got a distribution of 0.5, in which case that 15% is return over a 2-year period. However, you are interested in finding a return per annum, and hence we would say that okay, in such a case this will be 11 minus 10 plus, let us say, 0.5 upon 10 into 100 into, let us say, 12 by 24. So 15% per annum is 15% over 2 years is approximately equal to 7.5% per annum. Alternatively, this could have been the return over 6 months only. So your NAV went up to 11 in a matter of 6 months, in which case this is actually the holding period return, that is a return over 6 months. So 15% is actually for 6 months, which means if I want to annualize it, I will do 12 by 6, and hence the return will actually become 24%, no, 30% on a per annum basis. This is what you call as annualized return. In a lot of questions, you have been asked to do annualized return, and hence in such a case, you have to take the return and then do into 12 by M, where M is the number of months in the holding period, or 365 by the days, as the case may be. However, if the question remains silent or it asks you to calculate the holding period return, that is the return for the holding period, then you don't need to do the 12 by N adjustment, though most of the questions require you to calculate something called as annualized return. Now, this is done on a per unit basis, and we usually have no problem in that in case of a regular income scheme or in some other schemes as well, like growth schemes. But before you go to those schemes, we need to understand a very important plan that comes a lot of times in your exam, which is a dividend reinvestment scheme. So what happens over here is mutual funds, when they give out schemes, they would say that, well, we might distribute dividend, but we don't know whether you need dividend or not. Like, you are a successful professional, you have enough money, so you don't need a stream of income. You can reinvest that money, or if you're a senior citizen who needs a regular stream of income, you might need regular dividend. So we give an option that whether you want a regular income or you want a dividend reinvestment. So what will happen in case of reinvestment? For example, you have purchased 100 units. So if you have purchased 100 units at the start of the year, you can still find the total return in the exact same manner. So over here, you can do it on a per unit basis, or you can even do it on a total basis. So you can say 10 units, 10 rupees per unit into 100 units, that is the total investment, let us say, of 1000 at the start of the year. That becomes at the end of the year 11 rupees into 100 units, that is 1100, plus you have received during the year 0.5 into 100, that is 50 rupees as dividend. You divide this by 1000, your total investment, and hence you still get the same. Let us assume this was a single year return, you still get, if you calculate 150 divided by 1000, which is 15%. Because you start with 100 units, you end at 100 units. However, what happens in case of a dividend reinvestment plan? Well, in such cases, you need to remember that you can never do the return calculation on a per unit basis, because you are assumed that the 1 unit that you start with is a 1 unit that at which you end, which is not the case. You can start at 1 unit, but probably you are having more than 1 units. Like for example, in this case, you can start at 1000 rupees, which is made up of 100 units at the rate rupees 10, and at the end of the year you might have more than 1000. Sir, how is it possible? Well, rather than getting a rupees 50 distribution of dividend, that is 0.5 into 100 units, we say that we want new units. Acha, new units will be at what price? Well, new units will be at the price which price on the date when NAV is distributed. Now we don't know what the price is. Probably, let us say the price over here for simplicity is 10 only. Well, it can be different. It can be 11 as well. It can be 12.5 as well. So let us say we take a different price altogether. Let us say 12.5. In which case, this is the NAV on the date when dividend is distributed. So it is like saying that I give you 50 rupees worth of cash. You don't want that cash, so you give me 50 rupees back, and against those 50 rupees I'm going to give you units. Those units will be given based on the NAV on the date when the units are allotted, which is, let us say, 12.5. This is somewhere during the year, in which case 50 divided by 12.5, probably this will come to 4 units, I guess. This will be, let us say, 4 units, which means at the end of the year I am now having 104 units. But I don't have cash, so I cannot add anything because I have not received 50 as cash, but I have received 4 units. And these 104 units, all of them are worth 11. And hence you do 104 into 11. So that will come to probably, so this is 1144 if I am not wrong. So maybe there's some calculation, but as a concept, this is 1144 divided by 1000. So we are saying that 1000 that we started with, I did not get any cash. I got more units, that is 4 more units, which are worth 11 at the end of the year, and as a result you will calculate your return on a totality basis, which may be different from 15%. In certain cases it may be higher if the NAV is increasing, so you got new units at 12.5 and the NAV becomes higher, or it may even fall if you got new units at 12.5 and the NAV is even lower. So, but in dividend reinvestment plan you have to do this. Now sir, in exam questions, how do we know? Well, the question should usually tell you, and if it does not, it might give you hints, like you started the year at 100 units and you ended the year, or after 2 or 3 years you have more units. There's a very typical institute questions where you started at 10,000 units and after 2 or 3 years you have 11,296 point something units. That is a clear indication that unless you have purchased it and the question has not told you that, how did the number of units increase? Well, because you must have taken the dividend reinvestment option. So you need to be careful in that workings. So this is a dividend reinvestment schemes where dividends declared in each year are reinvested by the funds and additional units are distributed. These additional units will be total dividend divided by the NAV as on the date of dividend, and you need to remember that in such cases the return calculation will be done on a totality basis. Acha, then there are bonus schemes. Bonus schemes, well, you don't give dividend at all, in which case we will say that once the time is right and we have enough reserves, we will give bonus. And bonus over here, for example, you read, let's say something like 1:4, you read it as new is to old, which means for 100 old instruments you will get how much? 100 into 1/4, that is equal to 25. Even over here the return has to be calculated on a totality basis, so you will start at 100 units into rupees 10 and that will become 125 units. 100 plus 25, so 125 units at whatever is the prevailing NAV. There is no further distribution of dividend, divided by 1000 and that will give you the return. This is on bonus schemes. And then lastly you have growth schemes where there is no dividend, no bonus, so the NAV appreciates. You can do this on a per unit basis or even on a totality basis. In certain rare questions which institute does ask, they do tax adjustments. They might give you short-term capital gains, or they might give you STT, in which case you remember that your total return, total proceeds at the end will be calculated after deducting STT and after deducting the tax as applicable, and then you will calculate the return on a post-tax basis on an annualized, so into 12 by n. So if there are 10 years, that is 120 months, 12 divided by 120, you will get the per annum return. So you must have seen a couple of sun, moon and other types of questions. We're not doing it right now, but that I think you will get perspective of what I'm trying to communicate. Acha. Next, there is something of portfolio management which is overlapping, comes in portfolio as well as mutual funds. So this is fund evaluation, performance evaluation measures. Now, if I have money and I have 3 or 4 fund managers in front of me, how do I evaluate which of them are better? Well, there are 3 main ratios that you look at. First is the Sharpe ratio, where you take the reward in the numerator, that is the actual return, minus the risk-free rate. So even if they don't bear risk, we can earn the risk-free rate. So your actual reward is the return of fund manager X minus the risk-free rate, but that is risky, and hence you divide it by the measure of risk. So the measure of risk over here is the standard deviation. Now this is where students make mistake. They think Sharpe ratio means denominator should have beta. Incorrect. Trenner ratio with the same numerator has a beta denominator, because Trenner ratio assumes that the portfolio is fully diversified, and hence beta is the appropriate measure of risk. Sharpe ratio, on the other hand, tests whether the portfolio is diversified or not. Well, if it is fully diversified, the standard deviation would be lower. If it is not, the standard deviation would be higher, and hence a fund manager who is not diversified as well should be penalized by a lower Sharpe ratio, because he would have a higher standard deviation. And hence Sharpe ratio is generally considered to be superior to the Trenner ratio when it comes to general fund manager evaluation. The last method is also called as Jensen's alpha, where you take the actual return of a fund manager and compare that with the required rate of return. The actual return over here may be 18%, but we say that you should not really compare it with the risk-free rate, because this is a risky investment. Okay, then based on the risky investment, what should be your required rate of return? Well, considering beta, you can find the required return using CAPM. You have generated 18%. The required rate of return on a similar portfolio should have been 16%, and hence 2% is the excess that you have generated. And that is what you call as alpha. In all the 3 cases, we prefer managers with higher. So higher the better in either of the evaluation techniques. Sharpe ratio is generally considered to be the most superior among these. And the last part over here would involve the fund management strategies. Fund management strategies can be 3 strategies. There can be something called as buy and hold, which is a very simple strategy. You buy some bonds, you buy some shares, and you forget about it. So buy and hold. Second is constant ratio strategy, in which case you will want to maintain a specific proportion. So let us say 50-50 is your desired proportion, in which case let's say you start at 100 in share investment, 100 in bond investment, and you want to maintain 50-50. 1 month passes, let's say you want to rebalance after every 1 month. The shares become 120. The bonds continue to remain at 100, your portfolio is 220. But 220 is not 50-50 shares and bonds, so you rebalance. You say, okay, ideally the portfolio should be 110 bonds, 110 shares, and hence you will sell 10 rupees worth of shares and invest that money in bonds. You will keep on doing this to maintain the balance till the time you think it is appropriate. Again, this rebalancing will be done at specified intervals as decided by the manager, and after specified thresholds are crossed. So you might always say that, okay, if there's just a difference of 5%, we don't want to rebalance. If it is beyond 5%, you want to rebalance. Let us say this is constant ratio strategy, and then there is CPPI, constant proportion portfolio insurance, where you try to assess what is your maximum fall. So let us say you are making a 100 rupee investment and you are maximum in a position to bear a fall of 10%, which means your floor is 90. Your portfolio should not go below 90, and hence 100 minus 90, that is equal to 10 rupees, may be your cushion or buffer. So this cushion can be invested in equity. So probably 10 would be invested in equity, but if I'm slightly aggressive manager, I can have a multiplier. So I can say, okay, whatever is the cushion, 2 times of that I want to invest in equity. Then 10 into 2, that is 20 rupees you can invest in equity. In which case the remaining 80 will be invested in debt. Again, at the rebalancing date, you will assess. Let us say 20 of equity becomes 40. In which case your total portfolio is 80 of bonds plus 40, which means 120 rupees. Your revised cushion will be 120 minus the floor, that is 30 rupees, and you can say, okay, 30 into 2, that is equal to 60. I can still play with equity. You have currently had, let us say 40 rupees in equity. Now, let us say, you can invest another 20 by selling 20 worth of bonds and so on. So this is on CPPI. That largely takes care of the mutual funds. There are a couple of other concepts like load, entry and exit load. Like if you, in certain funds, if you enter the fund, you have to pay some load, that is transaction cost, which is added. And if you exit at the time of redemption, you will be deducted the proceeds. So exit load is deducted. Other than that, there is something called as dividend equalization, for which we have a separate video. You can refer the link for the video, and that should probably help you. So that largely takes care of the discussion on mutual funds. I hope this video has been helpful. Good luck, stay in touch, and I'll come with some other video fairly soon. Bye bye, take care.